Hi, this is Jim Anderson with First Citizens Wealth Management in Mason City, here today to bring you a brief market overview and outlook for the balance of this year. As we get close to the second half of the year, we're about 2 weeks away from the second half of the year beginning. We're seeing very strong equity markets. So far year to date, the Dow is up about 14.5%, the S&P 13.3%, and the NASDAQ a little over 7.2%. All 11 sectors of the S&P 500 are also up year to date, led by a very impressive energy sector, which is up over 48% year to date. An interesting fact: over the last 5 years, the S&P has set 180 all-time record highs during the last 5 years, and from our low in the market approximately 1 year ago, the market is up substantially. So it's been a very, very positive run here in the equity markets. We continue to have a very constructive view for the equity markets and the economy for the balance of this year, as we see the S&P have a price target of 4,500 on it by the end of the year, which is a little more than a 6% gain potential from here. And then even going into 2022, we see very strong equity markets as well, with a potential of a 5,000 price target on the S&P at the end of 2022. Now, obviously, that's not without a lot of headwinds. So we'll talk about those here in a moment, but some of the positives that we're seeing right now: obviously the accelerated vaccine rollout for the COVID-19. Obviously the Biden administration has a fiscal policy honeymoon still in place with Congress, as record amounts of spending are being dumped into the economy. And then also there's very easy comparisons year over year when looking at earnings growth in the S&P 500 as well as GDP growth. If we look at GDP growth for 2021, it's projected to come in at about 6.6%, and then even into 2022 we're seeing about a 4.5% growth potential for the full year. So very, very strong numbers going forward. And obviously that's attributable to the stimulus coming out of Congress, as well as the easy Federal Reserve policy right now. The Fed has basically indicated they're not even thinking about raising rates at this point, so the stimulus basically keeps coming for the equity markets. Obviously, some of the concerns that we have going forward: inflation continues to be an issue. Just looking at some numbers over the past year or so, corn is up about 108% year over year. Wheat prices are up 55%, and soybean prices up about 90%. So commodity prices have been just off the charts here recently. In addition, copper is up about 120% over the last 12 months. Crude oil 190%, and lumber is up a whopping 580% over the last year. So obviously that's having a big impact on home building at this point. At this point, the Federal Reserve believes that inflation is transitory or temporary. If that's not the case, it looks like inflation may be here to stay for a while. And if inflation is here to stay, the next question is, when will the Fed start to raise rates? So there's certainly some wild cards that we're looking at out there. Obviously, another big impact that we see having a possible impact on the markets going forward are the tax hikes that are being proposed. Both higher corporate taxes, higher individual taxes, and then obviously higher estate taxes are being proposed as well. So those are things that we're all keeping a very close eye on. I read an interesting article this morning that talks about the comparison of this economic recovery to ones in the past. So I'm just going to bear with me for a moment while I quote some of the topics from this article. But this is from First Trust Portfolios in Chicago, and basically they're saying, we keep hearing people talking about comparisons between this recovery and those of the past, as if it's an apples to apples comparison. For example, comparing job growth today to job growth in the 2008 and 2009 panic. All of this is in an effort to make the case that government spending creates economic growth. But there's nothing normal about the current economy. The things that our government leaders have done in the past year are unprecedented. As a result, using normal economic words and phrases to explain things like this makes no sense. These things have never happened before. Normal economic downturns are called recessions. Growth phases are called recoveries. And in the combination of these ups and downs are called a business cycle. This has not been a normal business cycle. The contraction in the economy last year was not a normal recession at all, and the return to growth this past year has not been a normal recovery. Comparing the economic recoveries of the panic of 2008 or Paul Volcker's tight money supply of the early 1980s makes little or no sense. In fact, trying to compare the current economic rebound to historical events minimizes the pain that the COVID-related and government-mandated economic shutdowns have caused. At the same time, giving credit to the government spending for creating the current recovery is simply not true either. Yes, it's obvious that when the government borrows money from the Fed or borrows money from future taxpayer and gives the money directly to the people, spending does go up. There's no question about that. But as far as it being a real and sustainable recovery based on those two things is not true. And using the Fed's favorite word is transitory. So yes, while it's true spending is up, it's true that the economy is expanding. There's no question about that. Part of this is because the economy is opening up, and part of it is because the government is borrowing money from the future generations to pay for this expansion. So the bottom line is the surest, in our opinion, the surest and most stable way to get the economic growth to be sustainable is to completely open up the economy and have a completely open and functioning economy. As we work in that direction, I think we'll continue to see growth and we'll work our way out of the recession that is probably already past, but again, still some areas of the economy that are suffering, and I think by opening up the economy, we will see this happen. With that said, we wish you a good day, and please stop in and see us if you have any questions. Thank you.